Hello all, I hope everyone is doing well. So in today's video, I'm going to talk about capital budgeting and certain metrics that are used for capital budgeting purposes, that is the NPV, the net present value, the internal rate of return, and the payback period. Before proceeding, kindly subscribe to the channel and also like and comment on the videos. So without any further ado, let's jump straight into the video. Now, what is capital budgeting first of all? Capital budgeting pertains to the decision making process. The managers of the companies have certain mandates of long term capital investments, or maybe investing in some equipment or project that is going to increase the cash inflows in the future. And this is done in order to increase the shareholders and other stakeholders' wealth. Now, in order to substantiate the capital budgeting and the metrics that are used in capital budgeting, I will proceed to the Excel that I've prepared. So this is the Excel that I've prepared for this video, and as you can see, we have two options here. So first is the investment property 1 and the second one is the investment property 2. So let's say a manager of a company is trying to evaluate these two options. First of all, we require certain inputs, that is the initial cash outlay, which for the first project is $800,000. Secondly, we also require the expected cash flows, and in this case the expected cash inflows are in the form of the rental that the investment property is going to generate. Then third is the discount rate or the opportunity cost. So this is nothing but the next best alternative to the investment that we're trying to make. And finally, we have the selling price of the property. So the company is planning to make an exit after 10 years. So before proceeding with the calculation of the net present value and other metrics, let us fill this table. So the initial cash inflow is going to be zero because the company will be spending the money, and that is $800,000. And I'm also making an assumption that there is going to be a zero cash outflow in the subsequent years, and also the cash inflows, the expected rentals. I will anchor this cell and I will replicate in the other cells as well. And now I will just take the sum of these two cells, and here we have the total cash flows. And there is one adjustment to be made here, that is in the cash inflows in the year 10, along with the rentals, will also receive the selling price of the property. I'll also add this in the cash inflows. So these are the total cash flows for the 10 years. Now, in order to calculate the net present value, which is nothing but the initial cash outlay less the present value of the future cash inflows. So for this, I will first of all go to the initial cash outlay, then I will add it. So I'm using the positive sign here because the initial cash outlay is already a negative. So plus the NPV. Just a word of caution here, the NPV function here in Excel calculates the present value and not the net present value. It's denoted as NPV, but it calculates the present value. So please be aware of that, because the net present value will be calculated once we add the initial cash outlay along with the present value. So for this, first of all, we'll have to go to the discount rate, which is 11%, then comma, and I will take all these cash flows. So all these cash flows in the subsequent years, and I'll close the bracket. So I hit the enter and I get this value. Now since it's a positive value, so this means this investment property is going to generate a positive cash flow, and it means since the net present value is greater than zero, so it is going to increase the cash flows, and hence the manager is going to accept this project. Here we can also talk about the intrinsic value and the asking price. See, if we look at the formula here, so G5 was the asking price, basically the initial cash outlay, the price that we have paid today, and this formula denotes the intrinsic value. So if the intrinsic value is greater than the initial cash outlay, it means that the net present value is going to be positive value. So either we can say the net present value should be greater than 0, or we can say that the intrinsic value must be greater than the asking price in order for the project to be accepted. Then we have another metric that is called as the internal rate of return, or the IRR. Now in order to explain IRR, we can take an example of, let's say, $1 that was invested say in the year 2018, and now in 2022 that dollar has increased in value and reached, let's say, $4. Now if I need a single rate of return at which this dollar has grown from 2018 till 2022, so what will that single rate of return be? Now this single rate of return is going to be known as the IRR. Although that dollar might have increased in value or decreased in value at different rates in the subsequent years, but if we need a single rate of return, that is the IRR. So in order to calculate the IRR, I'll press equals and type IRR. So I'll go to the cash flow starting from year 0 all the way till year 10, and I'll close the brackets. So as you can see, this gives me an IRR of 14.4%. Decision making process when it comes to the IRR is going to be, if IRR is greater than the discount rate, then you should accept the project. See, this is because the discount rate was the opportunity cost of, or let's say, what the next best alternative was. Now if that alternative was going to generate around 11% and the IRR that we are getting for this project is 14.4%, which is greater than the discount rate, then of course we're going to accept this project. So this is how we take a decision when it comes to the IRR. So it should be greater than the discount rate. But if it is less than the discount rate, in that case we will reject the project. Now there is something called as the payback period. The payback period is the number of years that it will take to recover the initial investment. So for this, I'm going to type a formula. If I'll also add a sum formula here. So I'm going to press a colon and anchor the column here, right? So I will say if the sum is greater than the initial cash outlay with a negative sign because this is a negative. Okay, bracket close, comma. In that case, return me a 0, else return me a 1. So as you can see, I have got a 1 here, right? So I'm calculating the number of years basically that it is going to take to recover the initial investment. Now what I will do is I will anchor this cell and I'll replicate this formula in all other cells. Now as you can see, till the year 9 I am getting the value as 1, and in the 10th year the value has gone to 0. So this means that the initial investment is recovered in between the year 9 and year 10, right? So the payback period is going to be, so in this case what I will do is I will say sum of, so I will take the sum till year 9, then I will add plus bracket minus of initial investment minus sum of the cash flows till year 9. So this is going to give me the amount that is remaining to recover the total initial investment, and after this I will divide this by sum of all the cash flows till year 10, and then I will subtract the sum of the cash inflows till year 9, and then I will add a bracket here and one bracket here. Alright, so as you can see, the payback period in years is going to be 9.05. The payback period is going to be considered when it is important for the company to recover the investment in the shortest possible time. So in that case, the projects can be compared on the basis of the payback period. Let's say if I'm going for the decision on the basis of the net present value, I'll say if the net present value is greater than 0, then you should accept or else reject. Now since we can see that the net present value is greater than 0, it means that the project can be accepted. And on the basis of internal rate of return, in that case we can say if the internal rate of return is greater than the discount rate, which is this 11%, in that case we can accept, otherwise reject the project. Now let's move on to the second project and see how the numbers fit in here. So the initial cash is going to be 0 and the cash outflows are also going to be 0 in the subsequent periods. The cash outflow here will be this, and the cash inflows are going to be $45,000. I will just anchor the cell and replicate all these values in the other cells as well, and I'll also make an adjustment in the last year for the selling price, and this is the total cash flow. Alright, so I will add all these cash here to get the total cash flows. Alright, so we have the total cash flows with us. Now we can compute the net present value. So for this I will take the initial cash outlay and then I will add the present value. For this I will go to discount rate and then we'll select all these cash flows in the subsequent periods. Alright, as you can see, this is a negative value. So this means that the project is going to be deteriorative. It's going to decrease the cash. So on the basis of the net present value, the decision is going to be reject the project. Now let's move on to the internal rate of return and see how the values fare in this case. So for this I will go with all the cash flows, and alright, as you can see, the IRR is coming out to be 11.8%, which is less than the discount rate. So this means that we are going to reject the project. And again, for the payback period, I can directly take the formula from above and I can paste it here. I will need to change this reference for the initial cash outlay, and that's it. Okay, perfect. So in this case also we're going to recover the initial investment in the period between year 9 and year 10. So for that I can take the formula for payback period from above and I can just paste it here. And as you can see, the payback period here is 9.15, which is slightly higher than the payback period here. And again, for the decision I can take the formula here directly. Okay, so this is on the basis of the IRR, and if we want to look at, let's say, the decision from the point of view of net present value, if it is greater than 0, then accept, otherwise reject. So you can see it is showing the decision as a reject for both the net present value and the internal rate of return. So on the basis of these values, we can comfortably say that the company is going to proceed with the project 1. Internal rate of return is also defined as the discount rate for which the net present value is equal to 0. Now what does this mean is, I will substantiate this with the help of a chart. So let's move here towards the right side, and as you can see here, this is the NPV for project 1, right? And I have taken different discount rates for this, and starting from 0% all the way till 21%. Now these values have been computed using the formula that we used here for the computation of net present value, that is the initial cash outlay, that is $800,000, and after that I have taken a discount rate here, that is 0%, and then the cash flows, right? So on the basis of this, I get the net present value as 1.5 million. So as the values of discount rate increase, you can see that the NPV decreases, and there's a point when it comes to zero, although it's not shown here, but there's a change from the positive to the negative values, right? So the point where the net present value for the project is zero, right? So that is called as the internal rate of return. So as you can see, this is a negatively sloped exponential curve, and these are the different set of values for discount rates and net present values. For example, if I hover over, let's say, this value, so this is going to show me that the discount rate is 4% and the net present value at this point is around 800,000. So as we increase the discount rate, the net present value is going to decrease, and there will be a point when this net present value becomes zero, and the discount rate for which the net present value is zero, this is called the internal rate of return. So now you have got a better idea of what the internal rate of return is. So this is all about certain metrics that are used for capital budgeting, and I hope that you have understood the concepts well. I hope this was a good learning for you all, and please consider subscribing to the channel. Thanks for watching, and see you the next time.